Okay. If you've been keeping an eye on the markets at all, you absolutely know the big story right now is gold. Just this week, we saw prices punch through the $4,000 mark, first time ever.
History being made. It's quite something to watch.
Yeah, it really is. This record high, it's signaling some intense interest from investors clearly looking to hedge risk, right?
Absolutely. Flight to safety is a major component.
Gold futures actually peaked Wednesday morning at $4,072 an ounce. That caps this just extraordinary run. The metal's up about 54% this year.
Which is huge.
It's huge. It's significantly outperforming most stocks in the S&P 500.
No question.
So today we're doing a deep dive into your research. We really want to understand the forces behind this, well, explosive momentum. We need to unpack the key drivers. Is it geopolitics? Is it skepticism about the dollar?
Yeah.
And then look at the forecasts, especially the aggressive ones from places like Goldman Sachs and the World Gold Council.
Right.
The goal here is really to give you a comprehensive sort of forward-looking view of what's pushing gold and, well, where the experts think it might land next.
It's definitely a remarkable moment seeing this price level. And as we dig into the material, you see the record price isn't just, say, an inflation story anymore. It's much more about this underlying heightened economic uncertainty and, of course, profound geopolitical instability.
So the classic flight to safety argument.
Yes, exactly. But it feels turbocharged right now by some really immediate factors.
Okay, so what were those immediate triggers? What specifically pushed it past that $4,000 threshold this time? Because a 54% gain in less than a year, that feels like something bigger is shifting, not just typical hedging.
You're right, it does. The most recent surge, it was directly tied to the growing uncertainty around the potential U.S. government shutdown.
Yeah.
To investors, that just screams political fiscal dysfunction.
Okay, makes sense.
But maybe an even bigger force has been this intense, well, fear of missing out, FOMO. We're seeing huge flows pouring into physical gold ETFs.
Right, and that FOMO, we can actually see it in the numbers, can't we? The World Gold Council data you pulled is pretty stunning on that front.
It really is. The WGC reported that gold ETFs pulled in a record $17.3 billion just last month.
Wow, $17.3 billion.
Yeah.
In 1 month.
Yeah. That kind of demand, it suggests, well, almost panic buying in some corners. It's often linked to political tensions, sure, a weakening dollar, yes. But also, interestingly, increased activity in the options market.
Wait, hang on. Options market activity. Maybe unpack that a bit. For listeners who don't track futures closely, how does volatility in options drive demand for physical ETFs?
That's a great question, actually. So when you see volatility spike in gold auctions, or maybe when large contracts are being rolled over, you have major institutions, market makers, who suddenly need to hedge their exposure very quickly.
Okay.
And a common way they do that is by using physical gold itself, or often the gold ETFs. That action, needing the underlying asset, accelerates the demand for it.
Ah, I see. So it creates this kind of feedback loop.
Exactly. A powerful feedback loop that then just juices the FOMO for retail buyers watching the price climb.
Okay, that connects the dots. And it brings us to this analytical term that keeps popping up, the debasement trade. This feels like a really core concept right now. Can you explain what that term means? Who's driving this trade?
Certainly. The debasement trade is fundamentally the idea that investors, and this seems particularly true for retail investors right now, are buying gold not just as a hedge against, say, CPI inflation.
Right, not the traditional inflation hedge.
No, it's more of a long-term hedge against a structural loss of faith, a loss of faith in the two main pillars of the global financial system, the U.S. dollar and U.S. treasuries.
So it's deeper than just worrying about prices going up. It's skepticism about the whole system's stability. What specific concerns are driving that skepticism, according to the analysts?
Well, the primary worries cited are, number one, the ballooning U.S. federal debt.
Yeah.
Just crossed $34 trillion.
Hard to ignore that number.
Right. Then there are perceived threats to the Federal Reserve's political independence. And third, something analysts are calling a sort of global structural rebuke of the U.S. dollar's dominance, its hegemony.
And the dollar weakening has a double effect, doesn't it?
It does, a powerful dual effect. It gives investors a reason to look for a non-fiat alternative, like gold, and at the same time, it makes dollar-priced gold cheaper for buyers using other currencies, so more demand.
And critically, this isn't just about, panicked retail investors chasing the price. Central banks are playing a huge role here too, structurally.
That's the really critical long-term anchor in this story. Global central banks are quite aggressively diversifying their reserves into gold.
Why gold specifically for them?
They view it as an asset prized for its, well, absolute stability during crises, whether economic or geopolitical. It's seen as a deliberate move away from assets like treasuries, which, let's face it, carry inherent political risk or potential sanction risk.
Gold doesn't care who's in charge.
Exactly. Gold is apolitical.
Okay, let's pivot a bit then. We've talked about why this is happening. Let's talk about where it might be going. Investors need to know, is $4,000 a ceiling, or is it just the new floor? Let's look at those analysts' forecasts, starting with that big upgrade from Goldman Sachs.
Right. Goldman Sachs, they clearly believe $4,000 is just a stop along the way. After seeing this momentum, they've upgraded their forecast pretty significantly. They now project gold hitting $4,900 an ounce by the end of 2026.
$4,900, wow. That's up quite a bit from their old estimate, wasn't it?
It is. Their prior estimate was $4,300, so a $600 increase in their target.
Okay, what's the core thinking behind raising the target so aggressively? They must see this recent surge as something more permanent, more sticky.
Precisely. That's the word they use, sticky. They view the recent inflows, particularly the central bank buying and this new wave of Western ETF money that drove the, 17% rally since late August.
Yeah, sounds about right.
They see that demand as sticky within their pricing models. It's not flighty hot money in their view. And because it's sticky, it effectively lifts the long-term starting point for all their future price projections.
So they expect this to continue?
They explicitly say they expect central banks, especially in emerging markets and these Western ETF buyers, to remain the dominant demand drivers through next year at least.
But here's maybe the most fascinating part of their analysis, for me anyway, the discussion about upside risk, specifically because of the gold market's, well, relative size.
Yes, I think that's perhaps the most important point for thinking about the long-term price potential. The analysts stress that the gold market globally is actually relatively small.
Small compared to what?
Compared to the truly massive scale of global bond markets like U.S. Treasuries or global equity markets.
Okay.
So this means if that debasement trade we talked about becomes more widespread, if more people lose faith in dollars or treasuries, then even a tiny rotation of capital. Imagine just 1% of the money currently sitting in the multi-trillion-dollar treasury market decides to move into gold. That small shift can have an absolutely outsized, dramatic impact on gold's price, precisely because the gold market itself isn't nearly as deep.
That really puts the scale of those debt concerns into perspective, doesn't it? If even a small fraction of institutional money, or even aggregated retail money, currently in traditional assets, decides the dollar risk is too high, the potential ceiling for gold just gets blown much, much higher.
It really does. It fundamentally changes the calculation for upside potential.
Okay, now let's turn to gold's other traditional role, the safe haven. Especially when equities hit turbulence, we sort of naturally assume gold goes up when the stock market sells off. But the World Gold Council's analysis suggests it's a bit more nuanced than that.
That's right. And this is where we need to apply some critical thinking, maybe push back against assumptions. The WGC certainly points to factors that could support gold. Right now, they note October is often a jittery month for stocks, and anxieties are high because of lofty valuations, maybe overly optimistic earnings hopes, high market concentration, things like that.
Standard checklist for market worry.
Exactly. But their research goes deeper than just saying stocks down, gold up. They look specifically at what drives that relationship or lack thereof.
So if stocks do take a tumble, what actually dictates whether gold benefits or not?
So the WGC analyzed 17 major stock market corrections going all the way back to 1973. They tried to isolate the variables. And they found, really, one defining factor seems to matter above all else in the relationship between stock sell-offs and gold's performance.
And that is?
Where the U.S. dollar goes during the crisis.
Wow, that's a pretty stark finding. It suggests gold's fate during turmoil isn't so much about the crisis itself, but almost entirely about the world's reaction to the greenback in that moment.
That's what their historical analysis points to.
But hang on, this raises a critical, sort of immediate contradiction, doesn't it, given where the dollar is trading right now?
It absolutely does. And the WGC addresses this directly. They issue a clear tactical warning. They say the dollar currently looks almost as tactically oversold as gold is overbought.
Okay, meaning?
Meaning, just looking at short-term charts and positioning, an oversold dollar looks like it's primed for a bounce-back rally. And typically, during a sharp stock sell-off, you might see foreign capital rush into the dollar for safety, causing that rebound.
And a stronger dollar is usually bad for gold prices, right?
Correct. So, theoretically, that dollar rebound during a stock crash could dampen gold prices, at least in the short term.
Okay, wait, so the WGC says the dollar's tactically set up for a rebound that would hurt gold. But their historical analysis says the dollar's direction is the only thing that matters, and usually gold benefits. Which force wins here? The short-term technical setup or the longer-term historical pattern?
That is the absolute core conflict for investors trying to position themselves right now. It's a tension between the tactical signal and the, let's call it, strategic or historical tendency.
So what's the good news for gold bulls then?
Well, the good news, if you're holding gold for the longer term, is that history seems to favor the systemic forces winning out, despite that tactical oversold warning for the dollar. And the WGC's analysis shows that during 2/3 of those 17 equity sell-offs they studied, the dollar actually fell anyway.
Even when it might have looked oversold going in.
Potentially, yes. It suggests that the underlying pressure, that fundamental distrust, the debasement trade we keep coming back to, might be so strong that when real panic hits, the systemic pressure on the dollar outweighs its short-term technical positioning.
So the flight from the dollar is stronger than the flight to the dollar in most recent crises.
That seems to be the implication, which overall suggests gold should still benefit from a flight out of equities into safe havens, even with the dollar potentially looking ready for a short-term bounce.
Okay, that's a crucial clarification. The systemic pressure seems to trump the technical setup in times of stress based on history.
That's the conclusion the data seems to lead to. But, for more active investors, people watching charts day to day, the WGC analysis does highlight some key technical support levels, just in case there is a shakeout.
Good point. What levels should people watch?
If gold does dip back below that $4,000 mark, the first important technical level is the 20-day moving average. Right now, that's sitting around $3,715.
Okay, $3,715.
If it breaks below that, it could signal a deeper pullback, potentially down to the 50-day moving average, which is currently hovering around $3,515.
$3,515. Good levels to keep in mind for risk management.
Definitely.
Okay, let's try to synthesize this for you, the listener. 3 core ideas seem to emerge from this deep dive. First, this current gold surge. It's not your simple inflation hedge story. It seems fundamentally driven by the debasement trade, a growing loss of faith in the U.S. dollar and treasuries.
Right. Trust is eroding.
Second, there's a strong long-term price floor being built because global central banks are acting as consistent, fundamental, almost sticky buyers, relentlessly diversifying their reserves away from traditional assets.
That buying pressure is significant and ongoing.
And finally, number 3, gold's traditional safe haven role during a stock market sell-off. It seems to hinge almost entirely on what the U.S. dollar does. But, crucially, historical precedent suggests gold will likely still benefit from that flight to safety, even if the dollar looks tactically oversold in the short term.
Well summarized. And maybe if we connect this back to that point from Goldman Sachs about the relatively small size of the gold market compared to, say, treasuries or equities, it raises a really fascinating final thought for you to consider.
Okay.
If just a tiny fraction of the capital currently parked in those massive markets is enough to potentially push gold towards $5,000 an ounce, what happens to the price if this debasement trade truly transitions from being, a niche strategic concept among analysts and certain investors to becoming a truly mainstream investor movement over the next few years? What if average people, pension funds, more institutions really start acting on those dollar and debt concerns in a significant way?
Given the relative market sizes, the implications for where the price could ultimately go are potentially, well, massive.
It's certainly something to think about.
Indeed. A very provocative thought to end on. We really hope this deep dive into your sources helps you feel better informed, maybe more confident about understanding the powerful forces driving the price of gold right now.